Which business entity is going to save you the most money on your taxes? A sole proprietorship, LLC, S corporation, or C corporation? Now, your tax expense can vary greatly based on the entity you select here. And by greatly, I mean thousands, if not tens of thousands of dollars. By the end of this video, I hope that you're saving thousands and not paying thousands more than you have to in taxes. Hey everyone, my name is Sherman. I'm a CPA here at Life Accounting, where we help businesses manage money and save money in their business. Today, I'm going to help you select the best entity for your business. This information is information that we typically charge for as a part of our tax planning service. But today, you get this information for completely free. And for more free content to help you save more money in your business, be sure to like this video and subscribe to our channel. With that said, let's begin. When it comes to entity selection, there are legal entity types and there are tax entity types. A legal entity is an entity that you register with your state, and your tax entity is the entity that you elect to file as with the IRS. For example, you can register your business as an LLC with your state for legal purposes, but elect to be taxed as an S Corp with the IRS for tax purposes. Meanwhile, for legal entities, there is no such thing as an S Corp. We'll discuss this in each type of entity in a moment, but before we do this, it's important that you understand the taxes that are involved for all entities. So let's talk about pass-through entities. The first thing you need to understand about entity taxation is pass-through taxation. Sole proprietors, partnerships, LLCs, and S corporations are taxed as pass-through entities. This means that all income your business receives passes through to you personally for tax purposes. For example, if your business made $100,000 and you owned 100% of that business, then you will be required to pay taxes on that $100,000 individually, not as a business. The exact tax you pay on that will depend on the tax bracket your total personal income falls in. And then there's something called double taxation. Only C corporations are subject to double taxation. Double taxation is where the company itself is taxed on all of its profits before payments to owners are made. And when those payments to owners are made, the owners are then taxed on the payments they received from the corporation. So you're taxed twice. Because of double taxation, C corporations are not the most popular choice amongst small businesses. So let's discuss a major tax that most small businesses encounter as pass-through entities, and that is the self-employment tax. Self-employment tax is currently an extra 15.3% tax on your income. It's basically the government's way of funding programs like Social Security and Medicare, which is normally deducted from your paycheck as an employee. Only difference is, as a business owner, you're paying both the employer portion and the employee portion of the tax, equaling a total tax of 15.3%. Now, here's the thing you need to know about self-employment tax. Self-employment tax does not currently apply to S corporations or C corporations. And because C corporations are subject to double taxation and S corporations are not, it shines a bright light on S corporations as a good entity choice to save on this type of tax. Still, S Corps are subject to some different rules that may complicate this. So let's look at each entity closely so you can determine which makes the most sense for your business. Number one, sole proprietorships and general partnerships. If you do not register your business with your state, then you are a sole proprietor by default. For example, if you woke up tomorrow and start cutting people's lawns in exchange for money, then you will be doing business as a sole proprietor. And if you and your friend decided to work together to do this, then you would be a general partnership. Sole proprietors and partnerships are both taxed the same. They just file in different places on their tax return. Sole proprietors report their business income on their individual tax return or 1040. And they use Schedule C to report the business income or loss from their business. Partnerships report business income on their partnership tax return or 1065. Each partner must receive a K-1, which basically reports what portion of the profits they are entitled to. Both entities can deduct business expenses to lower their income. You can deduct things like your advertising expenses, car expenses, office expenses, and much more on your return. Now, the major taxes they are subject to are federal income tax, state income tax, and self-employment tax. On the legal side, the most unattractive thing about sole proprietors and partnerships is that they carry substantial risk. The biggest legal risk is that you have no protection of your assets. For example, if you accidentally set your client's house on fire, then you'd be personally liable for all the damages. That means that if they sued you, they could go after everything you own. To prevent this, most people decide to organize themselves as an LLC. So let's talk about it. Number 2, a limited liability company. A limited liability company, or LLC, does exactly what its name says. It limits your liability for your company. By default, there is no extra tax benefit of registering your business as an LLC. It just protects you. So in the same example, if you accidentally set your client's house on fire, then you will not be personally liable if they sued you. Only your company will be liable, which means your loss will not exceed the amount you've invested into your company. For this reason, LLCs is one of the most popular entity types amongst small businesses. They provide strong protection and are very easy to set up. Now, on the tax side, the forms you file are different based on if you're a single member LLC or a multi-member LLC. Single-member LLCs file their taxes on a Schedule C just like sole proprietors. And multi-member LLCs file their taxes on a 1065 just like partners. Now, here's the interesting thing. As an LLC, you can elect to file as an S corporation for tax purposes. This would allow you to tap into the tax benefits of a S corporation without having to form a corporation. So number 3, let's talk about S corporations. S corporation is a special tax status granted by the IRS that lets corporations avoid double taxation and pass their income through to their shareholders like partnerships. To be clear, an S corporation is not a legal entity. You must have a legal entity in order to elect S corp status. For example, LLCs and C corporations can elect to be treated as a S corporation for tax purposes. You must be a domestic corporation with no more than 100 shareholders to become eligible for S corp status. And in order to elect S corp status, you must file a 2253 form with the IRS. If accepted, then you would file an 1120S as an S corporation on your tax return. This means that you would not be required to pay self-employment taxes. This is great, but there is one major rule. The owners of S corporations must pay themselves what is called a reasonable salary for the work they do in their business before receiving distributions of profits. This reasonable salary must be paid like you would pay a W-2 employee, which also means that you are still paying Medicare and Social Security taxes to some extent. In order to do this, you must first set up a payroll system to pay yourself and submit quarterly payroll taxes. And you also have to figure out how to pay yourself a reasonable salary. Now, the IRS provides some factors for you to consider, like your training and experience, or what you would pay a non-shareholder employee to do the same job. But still, the answer can still be a little unclear. And if you get this wrong, the IRS can go back and reclassify payments listed as distributions as W-2 wages that you must then pay taxes on. Now, this transparently intimidates a lot of business owners. But according to many CPAs I know, the unofficial rule that they go by is that a reasonable salary to pay yourself is equal to about 1/3 of the business profits. So as long as you're doing this as an S corp, I'd say you should be fine. Many people who are getting caught up with the IRS apparently aren't paying themselves any salary at all. Now here's the good news. By setting a reasonable salary, you effectively limit your exposure to self-employment taxes. For example, let's say you made $100,000 in income and paid yourself $70,000 as a reasonable salary. In that case, you'd only pay Social Security and Medicare taxes on the $70,000 and would not pay it on the difference of $30,000. And for you math nerds out there, $30,000 times 15% equals $4,500. That's $4,500 in tax savings just from choosing the right entity. So anyway, which entity is best for you? Ultimately, the best entity for you will depend on where you are in your business. But here are some very general recommendations that I can give you. When you're just getting started, consider starting off as an LLC. It's super easy to set up and will provide you limited liability for your business. Once you start making over $50,000 per year in business income, then you may want to consider electing S corporation status. This will limit your exposure to self-employment taxes as you continue to grow your business. All right, folks, I hope that helped you all. That's it for today's episode. And if this video helped you, please let me know by hitting that like button below. I'll see you in the next episode.